This is the Noon Business Lunch. We start today with our friend Craig Bolanos. You can always find Craig, frequently on this show. He's the co-founder and wealth advisor at VestGen Wealth Partners. Click on GetRetiredStayRetired.com. Hi, Craig. Welcome back.
Hey, John. Great to be with you. Busy week for everybody.
You're not speaking just about the tariffs here, are you?
I'm not speaking just about the tariffs. I'm thinking about the economy and the market and all these things coming together. And the story today isn't that the economy is weakening. It's not. The story is that markets are just becoming much less forgiving. Investors no longer pay any price for growth. Investors, we want profits, free cash flow, and disciplined spending. You add in some rising oil prices and geopolitics and higher rates, and it makes for an interesting week.
So that sounds like we are more forgiving. You said less forgiving.
Well, yeah, that's exactly correct. We are less forgiving because investors are now demanding not just that companies invest in AI. Investors are actually demanding to see scalable spending, and they actually are saying, where's the profit? I think all of this is healthy. It's a market that's just becoming more mature, a market that's becoming more broad, and I think intermediate to longer term, this is good for everybody.
Well, I heard a statistic yesterday that half of investors are worried about an AI bubble, and they are waiting to see the return on this massive amount of spending. I don't know that we've actually seen that yet, have we?
Well, we're seeing evidence of it. I understand what you're alluding to, John. I mean, hope, incredible hope over the transformation of this wonderful technology that is AI. It's hope that built this rally the last couple years. And now, I get it, earnings have to finish it. But what I see all of these non-technology companies, financial companies, industrial companies, material companies, who are actually benefiting in increased productivity per unit hour of labor coming from the technology investments they've made. That's what's showing up in earnings. So I know it's not fully proved yet, but it's starting to be reported out.
Yeah, but that's good for Caterpillar Tractor and construction firms. Are we seeing that in white-collar companies? Are we seeing that necessarily in the retail sector?
We're seeing that in the financial sector. I think you're seeing that. Thank you for calling out the industrials, like great earth-moving machines, Caterpillar. And I fully expect you to start seeing it in healthcare. And in the healthcare side, it's not just going to be the improved earnings. I think it's going to be the improved patient outcomes. And boy, that's got me excited.
Yeah, no, I don't want to argue with you, but I'm one of those people that's worried about a bubble here. So you said hope, and I can't retire on hope.
No, you can't retire on hope. You can't retire on nominal returns. You retire on purchasing power and strategies that are TNT, tested in the trenches. All those exist. We just need to open our eyes to them, be accepting of them, and move towards positive change. Okay,
so you remain bullish. The tariffs aren't setting you or the markets back either, huh?
Clearly, they're not today. I mean, this market is looking past the tariffs. Everybody knows that tariffs are here to stay. John, I'll repeat what I said last March and April. I was nervous as a long-tailed cat in a room full of rocking chairs when those reciprocal tariffs were first announced from the Rose Garden on Liberation Day. But ever since then, I haven't come to accept tariffs. I'm much more of a free marketer, but I understand that the tariffs are going to be here. And it's not going to be as much tit for tat. I think free markets are adjusting. And when I see things like the 12.5% rate replacing and going into effect and some of the newbies, it's just more noise. The market right now cares about oil, interest rates, and earnings per share. And 2 out of those 3 are okay.
Yeah, I was just going to say, it's 12:16. Okay, stay right there, Craig. More to talk about in a few minutes. Plumber.com. We're talking to Craig Bolanos, GetRetiredStayRetired.com. Are you worried about inflation? Was that the one that gave you a little pause a minute ago?
Yeah, the inflation gave me a little bit of pause. Even though the year-over-year changes look good, I understand that inflation and oil in particular is creating some dictation. You and I have spoken over the last couple of months that if oil were to stay in the $90 to $100 range for more than 100 days, it would start permanently anchoring itself throughout the inflation-linked economic chain. That would be bad for everybody. I would love to see us have somebody blink. I'd love to see a truce and a treaty deal. I don't need us to get back to $67 a barrel where we were in February, but I would like to get us back to the mid-70s. That would be very comfortable. And hey, any news headline could get us there.
Yeah, or get worse. I mean, not to get geopolitical about it, because I don't think any of us knows what's going to happen next, but now it's the Red Sea. Like if you're going to cut off the Strait of Hormuz, okay, we'll go the other side. And north and south, there might be strangle points there. So a pipeline across Iran isn't going to work either. And it wasn't Iran where the pipeline was, but you take my point that this thing could get worse as easily as it could get better.
That's correct. And that's why we all just need to remain balanced. You know, John, I never want to appear to be dismissive of any of the risks, because the risks are always substantial. The risks are always material when we're in an interconnected global economy. There's no doubt about that. But I stay anchored where I started this morning or this afternoon with you and your listeners, is if we step back from the headlines, the fundamentals remain remarkably constructive. I mean, the majority of companies are beating on earnings, not necessarily the last 2 weeks, but year over year, inflation's moving in the right direction. While I know there's parts of the consumers that are strained, the total consumer spending is still absolutely good. And as far as the employment goes, I refer to it as fragile, but it's historically strong. And I think the market's just adjusting to expectations in a world now where what you just said, the geopolitical risks have increased. Well, it makes me uncomfortable. It's not unusual. And for investors, I've seen periods like this historically reward us if we have patience, which is more important than predictions.
You think this is this is a time for buying as opposed to holding?
I think we've seen for quite some time now that any larger dips, especially in selective individual names that have been taken out to the wood chipper, has proven to be valuable over time. And you had said earlier in this segment today, look at the tremendous damage in the Magnificent Seven stocks. I mean, just the other day, erasing almost $800 billion in market value in one day. So when I think people look at great companies of America like Microsoft, that I affectionately call, Mr. Softy, I think there's value for people to selectively add to some of these names if they're currently underweight technology. But I think the big shout out to everybody is if you're overweight technology, overweight communication stocks, remember this market's broadening and we might want to start moving closer to something you and I have talked before called equal weights.
So broadening to healthcare, utilities, construction, are those the ripe areas? Banking?
Yeah, I mean, I'm a big fan. You just named some core components of infrastructure, and I think infrastructure remains such an undeniable trend in this country and around the globe, as there is a thirst for energy. There is a thirst for energy independence. There remains a thirst globally for data centers and the transmission mechanism through which those data centers need to get the data in and out. That's called cell towers, satellites, and fiber optic networks. All of that is infrastructure, and it's a very investable theme.
I don't know why this country then isn't more interested in subsidizing thermal, wind, solar, hydro, the green energies. We have nuclear plants in this country. Maybe we can build more, but shoot, you can throw up solar panels everywhere. And I don't know why we don't seem to be more interested in that as a national policy.
I can't tell you who decides to choose to pick the winners and the losers. Sometimes that happens with the lens of politics. But when I look at free markets and capitalism, I think different countries are going to do it different ways. And I think everybody should be warming up to what you just said. It's not a singular solution. It's not a duality of solutions. It's a plurality. It's any and all solutions. It's a race for energy independence and security, being able to keep up with the demands for energy, especially those demands posed by multi-industrial military complexes and the race for data. So who cares if we get it done with wind? Who cares if it gets done with solar? Who cares if it gets done with crude? Just find good ways to be a steward of energy and make it happen.
What's the 10-year Treasury at right now?
No, it's a little bit bothersome as we've been bumping up against 4.7%, right? I mean, that was pretty high and pretty shocking. I think we were 4.68, 4.69 here the other day, which is disappointing because if the yields get too high, one, it's bad for all the mortgage brokers and people looking to refinance, but two, you don't want to see bond yields start competing for equity money. And if you put your Treasury at, well, I mean, listen, as an investor who has balanced portfolios, there certainly isn't any reinvestment rate risk right now. We're all reinvesting at higher yields, but I do love growth. And in order to grow, we have to have money continue to go into equities, and that means I'd like to see bond yields lower.
Right. So ideally, the smart money would be equities, but if the trade is security and higher yielding bonds, I think there's a segment of our audience that would make that deal. They don't need a lot of growth. They just want to save and keep up with inflation. They don't want to lose.
No, you're right. I think a part of everyone's responsibility once we're on the cusp of or already retired is you only want to get financially secure once. And if you only need to get financially secure once, I think investing for income has got to be a part of the equation. And even if bonds aren't exciting, bonds create permanence and definition in portfolios so people can worry less, which allows them to live more. And we should spend more time talking about the right way to do bond investing in our appearances.
Yeah, maybe I should keep that in mind, too. I'm looking at my producer, Pete. Pete, we're done with this segment now, right? I've got to say goodbye to our guests, and I'm sorry about that because I think you made a really good point, and I love that phrase, you only need to be financially secure once. I've not heard that sentence before, but I think that's really telling. And then preserve the capital and know how to pull income off of it, right?
Get retired, stay retired, John. Get retired, stay retired.
Yeah. Oh, that should be your website. Oh, wait, it is. GetRetiredStayRetired.com. Craig Bolanos. Craig, we'll talk again. Nice to visit with you today.
Thanks, John. You're the best.